Let's review Groww IPO Prospectus.
Before you block 2 lakh rupees on the Groww IPO next week, I need to show you something buried on page 423 of their prospectus. I've spent the last 48 hours reading all 500 pages so you don't have to. November 4th, the Groww IPO opens. India's biggest investment app with 100 million downloads, #1 platform. Sounds amazing, right? But here's what they're not telling you up front.
Let's see who really gets the money.
In terms of structure, total IPO will contain 1,060 crores fresh issue, plus 557 million shares being sold by existing investors. That second part? That's the offer for sale, or the OFS. And here's the crucial part. The company gets 0 rupees from that OFS. 0. So while Groww raises money, the bigger story is early investors cashing out. Similar to other tech companies' IPOs, the early investors and VC firms paid a really lower price per share. But you'll pay whatever the offer price is, likely 400 rupees or more. Depending on the valuation, early investors stand to make very high returns on their investments, which is perfectly fine, but it's important for retail investors to be aware of this before applying for the IPO.
Let's see why you'll only get a tiny allotment.
Now here's where it gets worse for you. Retail quota? Only 10% of the total offer. And you're capped at 2 lakhs max. Meanwhile, institutions get 75% minimum. Do the math with me. If this IPO is oversubscribed 50 times in retail, which is likely given the height, you might get a really tiny share of allotment. As an example, that may amount to 4,000 Indian rupees worth of shares if you applied for the full 2 lakhs. Your money gets blocked for a week, just to be allotted peanuts.
Let's discuss the IPO eligibility issue nobody talks about.
But wait, this is the part most people will miss. Page 423 of the prospectus. The company is not eligible under normal IPO regulations. They're using something called Regulation 6.2. What does that mean? It's an alternate route for book-built IPOs where 75% must go to institutional investors and retail gets capped at 10%. The main issue is Groww reported a 805 crore Indian rupees loss in FY24 and didn't meet the 3-year profitability or asset criteria under Regulation 6.1a. Plus, there's the profit issue. Yes, they made 1,824 crores profit in FY25, which is solid. But in FY24, they lost 805 crores from a one-time US tax hit during their India restructuring. SEBI's profitability requirements don't care about the reason, as losses are treated as losses. Zomato, Paytm, Policy Bazaar, they all use this route. It's legal, SEBI-approved, and common for high-growth tech companies. But here's the catch. It forces 75% institutional allocation, leaving you with peanuts.
Groww lost revenue 3 months ago. Here's why.
Here's something nobody's talking about. From April to June 2025, literally 3 months ago, their derivatives revenue has declined. This happened because SEBI changed some rules about contract sizes. This is regulatory risk that has already happened once. One SEBI circular and a revenue stream drops. So you're buying into a business where regulators can change the game overnight. Plus, they're putting 205 crore rupees into unsecured personal loans via their NBFC and 168 crore rupees into margin trading. That's a deadly combination of credit risk and market risk.
Should you apply for Groww IPO?
Here's an honest framework. Apply only if you believe in India's fintech story for the next 5 years, or you understand that this is primarily a VC exit, not exactly a growth capital raise, or you're okay with significant drops post-listing, or this is less than 5% of your total portfolio. Avoid if you're expecting guaranteed listing gains, as there are none, or you can't handle volatility, or you're applying just for the hype, or you're using borrowed money. Therefore, if you're a long-term fintech believer with high risk tolerance, sure, invest your money. But if you're chasing a quick flip, you're playing the wrong game. The choice is yours. Just make it with your eyes open. Keep following this space for more such videos. Thank you for watching.